Markets don't fear bad news, they fear what most people haven't noticed yet. Most investors are taught to watch headlines. War, central banks, elections, price spikes, price crashes. And when those headlines hit, the assumption is simple. The market reacts immediately, emotionally, and obviously. But markets rarely work that way. By the time a story feels urgent, the first reaction has often already passed. Prices may already reflect the most visible risk. What actually moves markets next is usually quieter, slower, and far less dramatic. It's not the event itself, it's how expectations adjust after the event. This is why periods that feel confusing tend to matter more than periods that feel dramatic. When prices pull back but fundamentals remain intact, or when volatility fades while structural pressures quietly build, the real signal is often missed. Not because it's hidden, but because it doesn't match the story people expect to hear. Many investors assume that stability means safety, and volatility means danger. In reality, the opposite is often true. Stability can mask unresolved imbalances. Volatility can be the process of repricing risk honestly. So instead of asking, is this good news or bad news? The more useful question is, what is the market slowly adjusting to right now, and who hasn't noticed yet? That shift in perspective is where disciplined analysis begins. Over the recent period, precious metals prices have experienced a noticeable adjustment, marked by increased volatility, but without a breakdown in overall market structure. Silver prices moved lower from recent highs, retracing a portion of their earlier gains. The decline occurred over a relatively short time frame and followed a period of accelerated upside momentum. Compared to last week and last month, silver remains at a historically elevated level despite the pullback. The price is still well above the long-term averages that defined most of the previous decade. Gold has shown a similar pattern, though with less volatility. Prices softened from recent peaks but continue to trade within a higher range compared to prior years. The pace of movement in gold has been slower and more orderly than silver, consistent with its historical role as a lower volatility monetary asset. Platinum prices have also adjusted after a strong advance over the past year. While off recent highs, platinum remains significantly higher than levels seen earlier in the cycle, reflecting a broader repricing rather than a full reversal. From a market activity perspective, physical demand at the retail level has remained steady. Coin and bullion dealers have reported balanced flows, with buying activity increasing during periods of price weakness and selling activity increasing on short-term price strength. This pattern aligns with typical retail behavior observed during range-bound markets. Compared to last month, prices across precious metals are lower, but compared to the same period 1 year ago, they remain materially higher. The speed of recent price changes has been faster than average, though not unprecedented, and has occurred without a major disruption in trading liquidity. Importantly, there has been no confirmed structural change to supply, mining output, or exchange operations during this period. The price movement reflects market repricing rather than a response to a single verified event or data release. This establishes the current reality. Prices have corrected from recent highs, volatility has increased modestly, and the broader trend remains elevated relative to historical norms. Short-term price movements in precious metals often attract attention, but their significance lies less in the move itself and more in the chain reactions that follow. Understanding these cause and effect dynamics helps separate noise from meaningful change. The first-order effect of a price pullback is mechanical. As prices decline from recent highs, leveraged and short-term participants tend to reduce exposure. This can temporarily increase volatility and exaggerate price swings without altering underlying demand. These participants are typically the first to react because their positions are sensitive to margin, momentum, and short-term risk limits. The second-order effect appears in physical and long-term demand. As prices stabilize at lower levels, buyers with longer time horizons tend to re-enter the market. This includes retail investors, industrial users, and institutions seeking diversification. Their activity does not usually show up immediately in price, but contributes to volume support and reduced downside momentum over time. Another important transmission channel is relative valuation. When silver declines while gold remains comparatively stable, the gold-to-silver ratio adjusts. This can influence allocation decisions among investors who view precious metals as a group rather than as isolated assets. Shifts in relative pricing often matter more than absolute price levels when capital is being reallocated. Macroeconomic variables also play a role in the background. Interest rates, currency movements, and inflation expectations influence opportunity cost. When real yields stabilize or decline, the relative appeal of non-yielding assets such as precious metals improves. This effect tends to emerge gradually rather than as an immediate reaction to any single data release. There is also a behavioral dimension. After extended rallies, pullbacks can reset sentiment. Excess optimism is reduced, positioning becomes less crowded, and the market's sensitivity to negative headlines often decreases. This process can make prices more resilient to future shocks, even if those shocks appear significant on the surface. Who is impacted first matters. Short-term traders feel the effects immediately. Long-term holders and industrial users respond later based on pricing and availability rather than headlines. This staggered response explains why price weakness does not necessarily indicate weakening fundamentals. In short, what matters is not that prices moved lower, but how the market is absorbing that move. The current adjustment is functioning as a rebalancing mechanism, not a confirmed signal of structural deterioration. Periods like the current one are not without precedent, but history is most useful when it is used to create perspective rather than prediction. Looking back over the past several decades, precious metals have often experienced sharp advances, followed by corrective phases that felt uncomfortable but proved structurally important. In multiple prior cycles, prices moved rapidly higher, paused or retraced, and then spent time consolidating before the next major directional move. What mattered most was not the headline event that coincided with the correction, but the market conditions that existed before the outcome was known. In past episodes, similar patterns emerged: rising participation, increased volatility, and a shift in investor composition from early conviction-based buyers to late, momentum-driven participants. Corrections during those phases were not signs of failure, but part of the process by which markets redistributed exposure from short-term holders to longer-term participants. However, it is equally important to acknowledge what is different this time. The current price environment is occurring after an extended period of monetary expansion, elevated sovereign debt levels, and structurally higher fiscal spending than in many earlier cycles. These background conditions were not present to the same degree in previous decades and alter the baseline from which markets operate. Another key difference is market accessibility. Today, information travels faster, retail participation is broader, and physical metals markets are more transparent than in earlier periods. This changes the speed at which sentiment shifts, but not necessarily the direction of long-term forces. Industrial demand dynamics also differ. Silver's role in modern technology, electrification, and digital infrastructure is materially larger than it was in earlier historical comparisons. While history shows that industrial demand alone does not dictate price, it does influence the resilience of demand during periods of financial uncertainty. What history consistently shows is that emotionally charged narratives tend to peak near moments of transition, not resolution. The most informative signals typically appear when attention fades, not when it is most intense. The takeaway from historical comparison is not that a specific outcome will repeat, but that corrections within elevated price regimes have often served as filters, reducing speculative excess while preserving longer-term structural trends. History in this context helps reduce emotional bias and reinforces the importance of patience rather than urgency. Professional market analysis is not about forecasting a single outcome. It is about understanding a range of possible paths and the conditions required for each to unfold. From that perspective, it is useful to frame the current environment through three conditional scenarios. Bull case, strength reasserts over time. In the constructive scenario, prices stabilize after the recent adjustment and begin to trend higher again. For this to occur, several conditions would need to align. If real interest rates remain contained or drift lower, the opportunity cost of holding precious metals would stay manageable. If the US dollar weakens or trades sideways, rather than strengthening meaningfully, it would remove a common headwind for metals prices. At the same time, steady physical demand, both from investors and industrial users, would need to persist, absorbing available supply during periods of consolidation. In this scenario, Price strength would likely emerge gradually rather than explosively. The defining feature would not be sharp rallies but higher lows over time, signaling improving market confidence without speculative excess. Base case, range-bound consolidation. The base case assumes that current conditions largely persist. Prices move within a defined range, neither breaking decisively higher nor lower. If inflation expectations stabilize, monetary policy remains restrictive but predictable, and economic data continues to send mixed signals, markets may lack a clear catalyst. Under these conditions, precious metals often oscillate as capital rotates between risk assets and defensive assets. This environment tends to favor patient accumulation rather than momentum-driven positioning. Volatility declines, attention shifts elsewhere, and positioning becomes less crowded. Historically, this type of consolidation has acted as a reset rather than a resolution. Bear case, downside pressure increases. In the less favorable scenario, prices would move lower in a sustained way. This would require a clear change in underlying conditions. If real yields rise meaningfully, driven by tighter financial conditions or unexpectedly strong economic data, non-yielding assets could face renewed pressure. A sharp strengthening of the US dollar would amplify that effect. Additionally, if physical demand weakens noticeably while speculative selling increases, prices could overshoot to the downside. In this case, the key signal would not be volatility alone, but a failure of prices to attract sustained buying interest at lower levels. The purpose of outlining these scenarios is not to assign certainty, but to clarify dependencies. Markets respond to conditions, not narratives. Understanding what must change and what must remain intact helps frame risk realistically rather than emotionally. Rather than reacting to headlines or short-term price fluctuations, I focus on a small set of indicators that consistently influence precious metals over time. These indicators help distinguish temporary noise from changes in underlying conditions. One of the primary metrics I monitor is the US dollar index, DXY. Precious metals tend to move inversely to the dollar over longer horizons. A sustained move higher in the dollar can pressure metals, while stabilization or gradual weakening often provides a more supportive backdrop. What matters most is not day-to-day movement, but the broader trend and momentum. Treasury yields, particularly real yields, are another critical input. Rising real yields increase the opportunity cost of holding non-yielding assets such as gold and silver. Conversely, when real yields peak or begin to decline, precious metals often become more competitive as a store of value. I pay close attention to whether yield movements are driven by inflation expectations or by changes in growth outlook. Inflation data, including CPI and PCE, also factor into the analysis. Rather than reacting to a single release, I look for consistency across several months. Stable or gradually easing inflation tends to reduce policy uncertainty, while renewed inflationary pressure can alter expectations around interest rates and currency strength. Market structure indicators provide additional context. Trading volume, liquidity conditions, and open interest help reveal whether price moves are supported by broad participation or driven by short-term positioning. Healthy markets typically show balanced volume during consolidation, rather than sharp spikes tied to forced selling or speculative chasing. Finally, I monitor positioning data where available. Extreme positioning, either heavily bullish or bearish, often precedes periods of mean reversion. Neutral positioning, by contrast, creates conditions where markets can respond more cleanly to new information. Together, these indicators form a framework. None are decisive on their own, but taken collectively, they help clarify whether the environment is becoming more supportive or more restrictive for precious metals. Stepping back, the current environment in precious metals appears less dramatic than recent headlines suggest. Prices have adjusted, volatility has increased modestly, and attention has intensified. But these conditions are not unusual within elevated market regimes. The key takeaway is not about timing short-term moves. It is about recognizing structure. Markets are processing information, redistributing risk, and recalibrating expectations. That process rarely happens in a straight line, and it does not require urgency to navigate effectively. For investors, discipline matters more than conviction. Risk management, position sizing, and time horizons should guide decisions, not narratives or forecasts. Periods of uncertainty often reward patience rather than activity. From my perspective, this is not a moment to extrapolate extremes in either direction. It is a moment to observe, measure, and stay aligned with long-term objectives. Precious metals have historically played a role in diversification and capital preservation, but that role is most effective when approached deliberately. This isn't investment advice. It's simply how I'm reading the market right now. Staying grounded, informed, and patient remains the most reliable strategy, regardless of how the next headline reads.